So first off, what is Forex trading? Forex, short for foreign exchange, is the global market for buying and selling currencies. It's the largest financial market in the world with a daily trading volume of over $6 trillion. Unlike stock markets, Forex trades 24 hours a day, 5 days a week, and is a highly flexible trading option for anybody. In Forex trading, you're always dealing with currency pairs. This means that you're buying one currency while selling another. For example, let's say you're dealing with the euro dollar. This means that you're buying euros while selling US dollars. Now let's talk about some key terminology that you'll need to know. The first one being currency pair. A currency pair is the quotation between two different currencies. What that means is one currency is being priced against another currency. Second is bid and ask price. The bid is simply what buyers are willing to pay for a currency. The ask price is what sellers are asking for it. The price between the bid and the ask is known as the spread. The third term that you're gonna have to know to trade Forex is a pip. A pip is short for percentage in point. This is simply a unit of measurement in price in the Forex market. The next term you'll need to know is leverage. Leverage allows you to control a large position with a relatively small amount of money. While it can amplify profits, it also increases the risk of significant losses. The next term you'll need to know is a lot. A lot is a standard unit size of a transaction. In Forex, a standard lot is 100,000 units of the base currency. Forex trading takes place over the counter through a network of banks, brokers, and financial institutions, rather than on a centralized exchange. This means that you can trade currencies anywhere in the world at any given time. One of the most appealing things about Forex trading is the ability to use leverage. Leverage allows you to control a large position with a relatively small amount of money in your account. For example, with an account with 1 to 50 leverage, you can control as much as $50,000 with only $1,000 in your trading account. However, remember that while leverage can magnify your profits, it can also magnify your losses, so it's crucial to use it wisely. Let's say that you have $1,000 USD in your account with 50 to 1 leverage. This means that you can trade up to $50,000 in currency. If the trade goes in your favor, then the profits are multiplied. However, if the trade goes against you, then the losses are also multiplied. Next, let's talk about the different trading strategies that you might encounter. There are many different strategies that you might find out there, but they generally fall into two categories: technical analysis and fundamental analysis. Technical analysis involves studying price charts and using different types of indicators to predict future movements. Fundamental analysis focuses on economic indicators, news, and events to determine the value of a currency. In future videos, I'll dive deeper into different strategies that I've used to make money in the markets, along with sharing different things that I've learned from my experience that I think will benefit anybody that's looking to get into trading. I hope you found this introduction of Forex trading helpful. If you did, give this video a thumbs up, subscribe to my channel, and leave a comment below if you have any questions or topics you'd like to see me cover in future videos. Don't forget to check out the links in the description for more resources and to join our trading community. See you guys next time.